you need to have a team. You need to have that fractional family office feel of tax planning on your side. You need the experts, the quarterbacks on your team saying, hey, we're going forward on 4th and 5. We want to make sure that you know what we're getting into, and this is why we're taking these steps so that you can pay less in the future.
What you don't know is costing you commas and zeros. Welcome to the Owner's Profit Playbook. I'm Pat Mancuso. Most entrepreneurs think their biggest challenge is growing revenue, but the real problem is the profit leaks hiding inside their business. On this show, we break down the strategies, structures, and financial blind spots that separate struggling operators from truly profitable businesses. Because building a business is one thing, but building a business that creates wealth, that's the real playbook.
So welcome to the Owner's Profit Playbook. I am Pat Mancuso, and today we have an amazing guest who's going to share with us something that most people likely don't know that exists, and it could have a huge impact on their wealth building. And so we always start with our opening drive. And so most owners think they understand their Roth. If they have a Roth, they tell you it's tax-free, it's for later, I don't touch it. And on the surface, that sounds discipline. But the discipline without strategy is just a habit. What I see all the time is owners running complex businesses while letting one of their most powerful tools sit on autopilot. Today's conversation is about challenging that default setting. We're going to talk today about not about risk for the sake of risk, but about intentionality. Because when you understand how a Roth, or we're going to share in a second how a version of the Roth works and how it can work, it stops being a static account and starts being a strategic lever. That's what we're breaking down today with Greg Pearson from Trawick Financial. Greg, welcome to the show.
Oh, thanks, Pat. Thanks for having me.
So, Greg, I want to first let's take, we call it the 2-minute, but the 30-second overview. Tell me about Greg. Like, where's Greg been? What's he been doing? Obviously, I know a lot of this, but give us the 2-minute. Who's Greg?
Yeah. So Greg, I've been running Trawick Financial Services. We are a nationwide IMO that's been around for 30 years, but I've been running it as our president for the last 5 years since COVID. And as our president, I've been developing different strategies, and one of them we'll be talking about today. It's been a great ride and been a very good blessing to show clients and business owners how to be more tax efficient. I mean, taxes are kind of the big draw right now when it comes to what's taxes going to look like in the future. So we always have to be proactive. We don't want to be reactive. And I want to show you guys a little bit about today on how to be proactive with your taxes.
Well, Greg, thanks for that. So, one of the things that I'm certainly passionate about, and I know you are, and I know the teams that we work with are, is that everybody knows they have to pay taxes, right? I mean, taxes are in the law, they're in the code. The issue is, though, are you overpaying? Or as Garrett Gunderson put it, are you tipping the government? And, I know for me, and I'm not sure for you, this tipping thing has gone crazy in our world, right? Since COVID, in that everybody is asking for a tip. Yep. The last place I'd want to tip is the government on taxes, absolutely. Right? I mean, it's crazy. So I want to start a little bit at a 30,000 foot level, because I know we're going to drill down and you've got a presentation. Most owners don't lack intelligence. They lack context. They were told a Roth is good, so they funded it. And that is good, by the way. But that a lot of times is the end of the story. Would you agree?
Yeah. And in most cases, when you're running your own business, you think of your benefits last. And so some of those business owners that we talk about may not even have funded their Roth, or in some cases, were not able to fund their Roth because of income limitations. So it's very important to understand context, like you said.
And there's a lot of myths and myth understandings, I would call them, in terms of Roth. So give me like the top 2 or 3 right now, and you may have this in the slide presentation we're going to do, but just at a 30,000 foot view, what are the most 2 or 3 common myths people have about Roths?
Well, one of the top ones is if they make too much money, they can't have a Roth IRA. And that is true. You cannot contribute to a Roth IRA if you meet the IRS's guidelines. But the backdoor Roth conversion has always been available, even for our super wealthy individuals in the United States. You can always put it into a traditional account and then pay that tip to play and then get that Roth conversion happening so that you do have a Roth. And then the other kind of myth that most people don't know about a Roth IRA is most people think that, hey, if I put money into a Roth IRA, I can't touch that till 59 and a half. Well, that's a semi-truth. The reality is you can touch your principal before 59 and a half, which a lot of people, that could be a sizable amount if you've been contributing year after year. It's the interest that you can't touch tax-free before 59 and a half, or you will get a little slap on the wrist or a tip of about 10% extra that you'll pay to Uncle Sam.
And so, one of the things, and obviously there's always learning involved with this, and I still every day learn, is that, first, our audience today is really business owners, but we also have opportunities to help high W-2 income wage earners, number one. Number two, would you agree that it's a fair statement to say that one size doesn't fit all?
Absolutely. No strategy that has been presented to me has fit every client. And if you ever find a strategy that's proclaimed to help everybody, run far away. Because
Yes.
the reality is, if it's cookie cutter, you're not a cookie. You don't want to be wrapped up into something like that. So every strategy, including the strategy we'll talk about today, it needs to be bespoke. It needs to be self-contained, and it needs to be implemented perfectly for the situation that the client is needing, the business owner is needing, the high W-2 earner is needing. So if like I said, if you find a strategy or something that says, hey, everybody come, everybody, it works for everybody, be a little wary of that. Do a little bit more due diligence. But we love to show clients that the tax code is thousands of pages long. We want to make sure that we're using all of it. I heard a joke yesterday. We don't dodge taxes. We read the instructions. And the instruction manual is long. So you want to have a team behind you that's taking a peek behind every code and
Yeah.
change and update to make sure you're being the most proactive you can.
Yeah, I love that. I love that. I'm gonna have to remember that and use that. And you talk about the thousands of pages of code, and then there's the thousands times 10 pages of the interpretation of the code or the guidance of the code. And the other thing that I know you've heard, because we run in the same environment, if you may, is that is Ed Lyons, one of the tax attorneys for Excel Empire. It's not just one strategy. It could be 3 or 4 strategies that help a business owner or a high W-2 wage income earner. There could be 4 or 5 strategies that could help them reduce their taxes, and yet they don't always have to take advantage of all of them, and there's no pressure. But what we do, what the team does and what our different partners do is they look at that picture holistically versus being in silos. And that's why I love the thinking and the mindset and the team around what we do, including yourself at Trawick, because I think that's what's missing. I think there's too many people, too many business owners, too many high income earners that get advice. It's like a bullet and they fire the bullet, but they didn't understand how that bullet, what it's going to hit, what type of impact down the road. And so, that the complexity of it is, it's simple, but yet it's complex. And so I love that we're having this conversation today. So, you know what, Greg, anything else that, myths or stumbling blocks or just anything before we jump into the Roth Accelerator?
I think with another myth, and I was thinking of this while you're talking, is a Roth. It's more on the traditional side, but it's because the tax code is changing. But
Yes.
qualified accounts are kind of in a scary position. because you have literally signed an agreement and left a blank check with Uncle Sam and the state of your residence saying, I don't know what taxes will be in the future. And so I'm agreeing that, and we're hoping, right? We've been told for years, and this is the myth, that taxes will be less in retirement. But who's to say that the next administration, the next Congress, the joke is millennials and Gen Z will be running Congress by the time of your retirement. Do you want them deciding how much you pay in taxes? So, when we're talking about doing Roth conversions or the Roth Accelerator, we're using concrete data on what we have today. We know what the tax code says today. We're playing by the rules to help clients get out of that situation of the unknown.
Right.
And so if you're not taking advantage of what Uncle Sam is giving you today, you're making an agreement with Uncle Sam of tomorrow. And that's a scary place to be in. And we don't want to put any clients in that situation. So ignorance is not available or shouldn't be taken for clients. We want to give them informative decisions. You don't have to do these plans, but you need to be informed of these plans so that you have, you know what you had when you had it.
Right. I think the other thing that, it is really become is going through the CTBA experience and certification, Certified Tax Business Advisor process, is that many people, many business owners, and we'll focus on the business owner at this point, is that many business owners aren't aware, first of all, of what do they actually need out of their business when they exit. If they're going to exit, what do they need? What do they need to, there's two or three questions here. What do they need? What do they need to maintain the lifestyle that they have right now or the lifestyle they desire to have? And then the last thing is the blind spot is they just don't realize that when they do exit that business, sell it, change the structure, whatever that may be, they're now not a business owner, which means their taxes are impacted and they lose deductions that they otherwise already had unless they set it up the right way as they're moving towards that. Is that a fair statement?
Absolutely. I joke all the time. The Internal Revenue Code was built by business owners for business owners. If you're not taking advantage of the IRC while you're a business owner and you sell and now you're, just a regular individual filer, you've lost out on a lot of opportunity that we could help you with while you were a business owner. So take advantage while you can.
Absolutely. Absolutely. Okay, Greg, let's jump into this Roth Accelerator. I am so excited to share this with our listeners.
Yeah, absolutely. So I'm going to share my screen and we'll jump right into the presentation. I'll be short and sweet, just getting the high points here. So I hope that can be seen there.
Yes, sir.
All right. So I want to start out with a story. And the story is really going to be showing why getting your money into a tax-free environment, getting it out of the tax jail that it's in is really important. And just like some of our greatest teachers, stories or parables allow us to see what we need to learn from them, to relate them to real life. So we're going to go into a story about the power of compounding growth and how taxes affect that. So we start with our story with Jane and Sarah. Now, Jane and Sarah both are great investors. Maybe they're business owners. They're using, they know how to play offense, right? They know how to make money. And so they're investing their money, the same investments over and over. The difference is Sarah gets to invest her money without taxes, while Jane has to pay taxes along the way. And so when I tell this story and I say, hey, let's play a game here. What if we did a doubling of their investment every day for 30 days? Maybe they picked the right stock, bond, mutual fund, or maybe they were just good with their business. They were able to double their investments every day for 30 days. Most people would say, well, taxes would eat into that. We understand that, but they don't understand how much taxes will impede the growth until they see these numbers. So with taxes impeding that penny that was doubling every single day for 30 days, right? You don't have 30 cents at the end of the 30 days. With taxes, you would have $48,000. Now, most people would say, wow, that's an amazing ROI, an amazing return. You should write a book on how you made that much money. But they would be wrong, because Jane had to pay taxes every time she passed go, every time she had a gain. And as business owners or people with high W-2 or just anybody that sells an assets, they understand making money feels great, paying taxes does not. Look, if we go to Sarah, Sarah did not have any taxes impeding her growth. And she had the same investment ideas that Jane did, nothing different, right? But without taxes, she was able to have, at the end of the 30 days, $5.3 million. Well, everybody wants to be Sarah. And so that's what the Roth Accelerator is showing clients is, hey, you have your money in tax jail. It's in a qualified account. Maybe you've been told your whole life by your CPA, shove money into your SEP IRA. We'll deal with the taxes later. Maybe you're high W-2 and you've been contributing and getting that match into your 401k. And you're thinking, hey, this is the best thing. You know, I'm growing my money and getting a deduction. But we want to show you why that may be a fallacy. So here's the fallacy. There are $15.2 trillion in IRA accounts nationwide. But guess what? There are $38 trillion in our U.S. national debt. And in fact, I had to change this slide this morning.
You might have to change it by the afternoon. You might have to change it by the afternoon.
Yeah, my next call, it'll be 39 probably.
Yes.
So here's the craziness, right? You've made your blank check, you've made your agreement with Uncle Sam, and you've signed it without knowing the amount. You don't think that inflation and taxes are going to drive the IRS or Congress or the Senate to create different ways of taxing you on retirement? They know where the money's at. Trust me, it's not in XYZ, it's in your IRA or your 401k. So we suspect every time there's a tax change, there's always a little thing added to your IRA that always seems to diminish what you can do with it. The last change in the Secure Act was they got rid of the stretch IRA, right? Now it's down to 10 years. So if you inherit a tax-deferred account from a spouse, or I should say from a loved one, you're going to have to take that money out over 10 years, or you're going to get penalized. Used to be you could take it out over your lifetime and people could spread the tax bill out. I believe, along with our tax attorneys, we believe that eventually we're going to have the Secure Act 3 come out, where they're going to say you got to take it in a lump sum. Because the IRS and Congress, they know what they're doing, right? If we look at what they're doing, do you think they're shoving their money in tax deferred? No, they're shoving their money in tax havens where they'll never be taxed again. And so traditional wisdom would say, okay, Greg, we understand, keeping it in the IRA is a bad thing. Well, we have known about Roth conversions for a while. Let's just do that. And so on my next slide here, that's what we want to talk about, right? A traditional account is taxable when it's withdrawn. I was talking to a gentleman a couple months ago, and he was surprised at how much taxes he had to pay when he pulled money out for RMDs, right? The IRS is going to force you out if you live too long. They're going to force it out if you die too early. And he was like, hey, I've never sold Apple. Why am I paying ordinary income taxes? This should be capital gains. You lose out on, some of the favorable tax treatment of non-qualified accounts by holding it over a year for long-term capital gains. They're going to tax you at ordinary income rates. And by golly, we have no idea. Even as tax professionals, we have no idea what those are going to be in 10, 15, 20 years. So the goal is to get it into the tax-free realm. And conventional wisdom is we're going to do that. But if we do that, we're going to get hit with a huge tax bomb, which is it better? There's so many mathematicians that play these numbers. Is it better to pay your taxes now and let it compound tax-free, or play the game of we should hope and pray that taxes will be less? Well, when we do a conversion like that, that is not a good way. Sending all of your money in a lump sum, jumping up to the highest tax bracket in one go,
Yeah.
that is not good. That
Yeah.
is not smart. So what do most people do? They simply slow and limit. They do their Roth conversions over several years, every year. But I got to remind ourselves about the story I just talked about with Jane and Sarah. This is exactly the same story where every year we decide, hey, let's not jump into the 37. So let's move a couple $1,000s of your traditional to your Roth, right? But
Right.
that's going to impede your growth. So we're going to slow down what we can compound on because every year we're paying our taxes as we costs go. And in some cases, you're very fortunate. You have too much money to spend trying to stay in the 20% tax bracket range. And so this all came about when we were talking with our clients and saying, hey, we understand we're here to help you with your income taxes today, but we understand that the largest problem that you have is going to be those qualified accounts. And so that's where the Roth Accelerator came. So how does the Roth Accelerator work? The Roth Accelerator works this way. We take your traditional account. We are going to move that traditional account into a tax-free Roth-like environment where legacy is tax-free, leaving it behind to the next generation, where income is tax-free, where it's not going to impede on your Medicare or IRMA. It's going to create an environment that it's simply not what you own, but how you own it, right? The joke is buy, borrow, die for the rich. We're going to create a similar environment on your traditional account. And then the question is, Greg, if we're doing that, how do we get around the tax bomb? Well, that's where we get into offsetting your income. Like I joked before, we're not dodging taxes, we're just reading the instructions. When we convert your money over to this Roth-like environment, our tax firm is going to assist you in creating strategic offsets. Think of it like debits and credits, right?
Right.
You're debited your income as you take it out of qualified. Well, we're going to credit you with a deduction that offset those incomes. It's no strange thing that our richest billionaires in our country pay less taxes than their secretaries.
Yes.
Warren Buffett, right? He pays
Yep.
less taxes than his secretary. The reason why is they're using the tax code the way it was created, which is play by the rules, make money, save money. And so as we convert, we are going to depreciate and we're going to be able to move your money faster, more efficiently, and get you into those lower brackets as we're doing these conversions. I know it says 10 or 20% or lower. Most of our clients that are doing these conversion are actually getting to a 0% tax bracket, meaning we are getting them up to their income number up to a certain amount, but we're getting enough depreciation so that the IRS says, you made money, you lost money, it's all washed.
Right.
You don't have to pay us anything. And the client, of course, feels really good and well knowing that they're never going to have to pay taxes on those dollars again. And they never did on moving them over.
Yeah.
And so some of these strategies, again, the Internal Revenue Code changes every year and we stay on top of it. But some of these strategies can be depreciable strategies, right?
Right.
Planes, trains, automobiles, the book, right? Anything with wheels can be fully depreciated and we can help the clients take advantage of that as they move their taxable into the tax-free. Energy strategies are still available for a while, meaning we might be able to find certain tax credits that
Right.
allow you to, and credits are better than deductions every day of the week, that allow you to say, hey, as we move your money from your left hand to your right hand, these tax credits are going to pay the bill so that you don't have to. And then finally, for those business owners and high net worth individuals that are charitable minded, we have a lot of charitable strategies that allow you to be leveraged, meaning
Right.
if you're interested in a certain charity, we can leverage a donation to them to offset more of your taxes for less money, cash flow out of pocket. Usually it's about a 5-to-1 or a 7-to-1, depending on the charity. But simply put, for every dollar you donate to that charity, you can get $5 to $7 off on your taxes. So if you're in a 35% tax bracket and you get to write off $7 for every one, you can see that you're saving $2 to $3 per dollar you put in. And, hopefully you enjoy being charitable too.
Yeah, absolutely.
And so this brings us to our final slides is we have no idea what strategy is going to be best made for you with the Roth Accelerator. But I can tell you what, we have enough strategies and we have enough opportunity to say we should probably look and analyze your specific needs and goals so that while we're talking about moving your money from the left hand to the right hand, you can know the ins and outs so that if you feel comfortable with this type of a perform, we can then move forward on that. And so finally, the biggest question I always get for clients is, hey, planes, trains, automobiles, solar credits or wind credits, or even charitable, how's that going to affect my cash flow? Well, that's the brilliance of this plan is we actually create the plan to pay for itself, meaning the strategies that are going to offset your taxes will be paid by the plan itself. So no extra out of pocket is needed by the client. Simply put, we're helping you own assets versus paying taxes. And those assets depreciate to offset the income. And at the very end of the rainbow, your money is on the left side and it's all tax-free for legacy. It's tax-free for income. It's tax-free for any sort of, any sort of timeline that you have, right?
Right.
A traditional account, you got to be 59 and a half. These accounts, there's no time restriction either.
Right.
And I joke this all the time with our agents and our clients, but the only person that's losing out on this whole operation is the IRS. I don't think anybody's crying a tear for them tonight. They've taken their fair share.
Yeah.
So finally, the call to action is we would love to meet and work with each individual who'd be interested in seeing what their opportunity would be.
Right.
Again, these are bespoke plans. There's no cookie cutter way around this. We build every single one to be maintained, operated, and efficient for the person who is purchasing it. And I hope to, get to meet some people from this podcast and show them what we could do and how their tax-free future could look like. So thank you so much, Pat. I'll stop sharing here and we'll just jump into some questions.
Yeah. So first, I mean, wow, every time I hear it, every time I hear you talk and, the whole puzzle, like there's so many pieces to it, right? And that's part of the challenge for people is they don't even know what puzzle pieces are out there. So let me, your offer at the end there. So what if somebody wants to evaluate any of the strategies they're doing right now, they can do that for free. There's no charge for that, correct?
Absolutely. Yeah. Every time we meet with a client, there's no fees to see how the plan is working. We will build the whole bespoke plan down to the T and then say, hey, if you want to move forward, here's what you need to do to move forward. But again, showing them the opportunity, no fees involved.
So, Greg, anytime we talk about doing something different, owners worry about there's probably a laundry list, right? We worry about mistakes being made. We worry about the strategies that are being used and are they legal and am I going to get audited? And we could go on and on and on and on and on. What do you see are the most common, we'll say Roth misplays you see, like real ones, not theory, where people are leaving tens of thousands of hundreds of thousands of dollars on the table?
Yeah, well, I think the biggest misplay is dying without doing a Roth conversion.
Does that, as a percent, how often do you think that happens?
Oh, I think it's probably in the 70s or 80 percentile where you're going to have more people leaving behind traditional accounts because they do what most people do. I get it. We're all human. Jumping into something that you're not familiar with, sometimes it's better just to hold your breath and wait, right, until you feel more comfortable. But that's where we build around the client, right? we're going to have a tax attorney, a CPA, a full team, show them what they're missing out on, and then say, hey, we're not in any rush. Whenever you're ready to take this plan of action, we're going to be with you each step of the way. We're going to help you file your taxes, right? We're not going
Right.
to put our name on anything that we don't fully stand behind.
Right.
And so I think as a business owner myself, the biggest thing that hinders me from taking advantage of different strategies that come about, whether it's talking to somebody that says, hey, I'm going to clean your building for cheaper, is I just don't have the time. And on top of that, I just don't know if it's going to be worth my while.
Right.
Well, here's our offer to you. I guarantee you, we're going to show you how to save money on taxes, which there's going to be a true dollar savings on that. And if we're in the business to make money, saving money on the defense side is just as important as the offensive side and you pushing more sales.
Right.
And and I know that business owners focus on offense and defense wins championships. Well, I mean, just look at IU against Miami. That interception at the end of the
Yeah.
game is the reason why they're champions. So,
Yeah, I knew we would get there. I think every conversation now was about the national championship. It comes up there.
yeah.
Uh, so I want to just make this point, and I'm pretty sure you'll agree with it, that we don't talk about isolated decisions. Everything lies inside of a bigger system. What in tax planning, cash flow, exit strategy, legacy. And you said something earlier which struck me. You said, a very large percentage of people die without converting it. And then if you compound that with the number of people who die without converting it and don't have wills, oh my gosh, the money they're leaving on the table.
Actually, we've theorized that the IRS is the largest beneficiary of most qualified accounts. Because think of it like this. If I have two kids and I leave my $1 million in a SEP IRA to them, and if I die in my 80s and they're in their 50s and 60s and they're your good income years, they're going to be up at the 37% tax bracket. Well, if you add 37 plus 37, you're over 50. And the IRS is your third child inheriting more of your money than your two kids.
Yeah.
And so when we're talking about planning, it's not just planning for income and retirement for your life. It's setting up the family tree to be successful for generations to come.
Yeah.
And it's a compounding effect both ways. If you don't plan correctly, guess what? Not very likely that the next generation is as well. And as you know, generational wealth is, was it 3 generations? It's rags to riches, back to rags in 3 generations. And as business owners it's a great opportunity to say, you know what? We've been fortunate through our sweat, our equity, that we've created wealth. We want to maintain that wealth for generations to come, leaving that legacy. And without planning,
Yeah.
you're taking a big risk that legacy is going to fall flat.
It'd be like a business owner starting a business and then doing nothing in the business to improve it, and doing nothing to learn about how to improve it, how to improve themselves. I mean, it's an asset, and assets are meant to be grown, and they're meant to be, increased, and they're meant to have impact. And so I just love what you guys are doing there. So I want to switch gears just for a second and just talk about we call them the 2-minute drill, and it's really just some let me hit you with this and what's your quick response. Biggest Roth myth owners still believe.
So again, the biggest myth I think that Roth owners, people that have Roths out there, is when we have a Roth IRA, they think it's going to be tax free. That's true. But when you have a Roth IRA, you're still limited by when you can take the money out. So you have to be 59 and a half. And if you pass away, yes, it does pass tax free to your heirs, but it's usually just dollar for dollar. And so when we have somebody who comes to us that says, hey, I've got a large Roth IRA, what should I do with it? Is it good? Is it well maintained? We do a complex, strategy look into what they have, because it's great to have a Roth IRA, but what is it invested in? You can still lose money in a Roth
Right.
IRA. You got to make sure you're protecting the eggs to make more of them. And so, but again, the biggest myth I think is most people believe about a Roth IRA is either A, I make too much money, I can't have one. And so we show them the backdoor conversions, whether it's a traditional Roth IRA or even the Roth Accelerator.
Yeah.
It's just, sometimes ignorance keeps people from moving forward, and we're happy to educate.
Yeah. Like one of the questions is what's the long-term cost of doing nothing? Ignorance. Exactly. So let me, what about this? One sign of Roth is being underutilized. How would you respond?
What was the question again?
One sign of Roth is being underutilized.
Yeah, if I look into a Roth IRA and I ask the client, "Hey, so what is your goals and objectives?" and they don't have goals and objectives for it, that's a big red flag. Usually, they've put the money in an equity position in a company that they don't watch or don't keep up with, and so it's the risk of, hey, you might have moved your money, paid your tax bill, but you're still in something a little too risky at your age to play
Right.
with. I think the 4% rule, which is an income bearing rule on retirement accounts, is great, but it really gets into a problem with sequence of returns. If you look back at history, we're well overdue for some sort of correction. And who wants to be taking income out of a depreciating asset that every time they touch it, that compounding interest goes negative for them?
Yeah.
And so when we show clients the ability to leverage their retirement account safely and show them, hey, we don't care what tomorrow brings. We're going to we're going to actually take the risk off the table and get more guarantees for your retirement. And we're going to remove the tax equation from it. I
Right.
think clients are very, very excited about moving forward.
Absolutely. Who should not make Roth moves without guidance?
Well, the tax questions, you should have a tax professional leading the way for
Yep.
those. Just because tax code changes, you don't know
Right.
what your limits are, what might be the best place. Maybe that deduction, throwing the money into the SEP IRA this year, was not the best use of the dollars.
Right.
Because as a business owner, yes, you do get the deduction in the year you push money into the SEP. But guess what? You've locked those dollars up until 59 and a half. And most business owners need liquidity, right? The
Right.
liquidity is the death of most businesses. We're going to show you ways of getting into a tax-free world and keeping the liquidity alive. I think
Right.
that's very important.
Well, Greg, this has been amazing. And so I'm going to ask you before we go into our final drive here, what one thought, we had an amazing conversation today, but what one thought would you leave our listeners with?
Yeah, so the one thought that I hope that if you didn't memorize anything that you just heard is that the tax code is not the enemy. The tax code is an ally to you. You have to use it though. So most people see the tax code as, oh my goodness, here's 1,000 different ways I have to pay taxes. But for every way to pay taxes, there are 1,000 plus ways of how to avoid legally paying taxes through deductions and credits. And the one thing I want to leave listeners with is you need to have a team. You need to have
Right.
that fractional family office feel of tax planning on your side. You need the experts, the quarterbacks on your team saying, hey, we're going forward on 4th and 5. We want to make sure that you know what we're getting into, and this is why we're taking these steps so that you can pay less in the future. And so don't look at the tax code as the enemy. Look at it as an asset to you as long as you know what you're doing, and find those teammates that know what they're doing. I think that's the goal for most people is be proactive with taxes. Don't
Right.
be reactive to them.
And Greg, it's why I know you and I have the passion for what we do and what we're involved in and the teams that we have behind us, because the fact of the matter is I'm not sure unless you're on planet Zion, which I'm sure there's a planet, taxes are going to go up. When you just understand the economics of the economy, they're going to go up. I mean, they go up. Like think about like last year to this year, and people only sometimes focus on the taxes they pay on April 15th or on October 15th. but go buy something. Your taxes went up. Your government, your city, your state, all your taxes are going up all the time. And the fact of the matter is you don't have to overpay. And yet I know people, there's a fear. There's just this fear of, well, if I don't pay, like you mentioned earlier, if I don't pay any taxes, oh my gosh, well, the fact of the matter is that if you're utilizing the tax code, and if you're documenting, and if you're substantiating, and if you have a team behind you to defend, because, sometimes the IRS disagrees with things that people do, the fact of the matter is that your ultimate goal is to build wealth. And that's clearly we can see that's not the goal of the government based upon their debt, right?
No, absolutely not.
That's not the goal. So I appreciate that. So here's the takeaway for owners. Okay, this is my thoughts based upon what we talked about today. Is you don't win by freezing assets in place. And if you put a Roth in place and you don't do anything with it, you lose. You win by understanding the situation, the timing, and the role each dollar plays in whatever that strategy is, whether it's a Roth, whether it's a sub, whether it's your business, okay? They're all strategic assets. And like every part of your business, it deserves a review. It deserves intention and alignment. So Greg, I appreciate you coming and helping owners and really helping them to rethink a tool that it sounds like to me that's often established and then left, contributed to and left. And yet for me today, the questions you raised about how your assets are positioned, that's not the problem. It's really about awareness. It's about how do you take that asset and put it to work for you. And that's really what I was excited about today. So, Greg, thank you so much for being on our show today.
Thank you for letting me be here.
And listeners, thank you so much for supporting us. And if you want more information on what we do, Greg described it in a really, it's how I think. I think that in my role, I feel like I'm a quarterback helping business owners, whether it's tax credits, whether it's tax mitigation, whether it's tax planning, whether it's life insurance, whether it's investment strategies. There's so many things that are available out there. And yet I ask this question of every business owner I talk to, and this isn't a slam, listeners, on who your advisors are. But just hear the question: when was the last time your advisor, your CPA, your tax strategist, your Roth folks, when was the last time they brought you a strategy? Not you brought them. And if the answer is never, which it usually is when I have conversations with business owners, I can assure you you're leaving money on the table. And in my world, that's the question I ask business owners is I say, what you don't know is costing you commas and zeros. And so what don't you know? Thanks, everybody. We appreciate it. Greg, have an amazing day. Stay warm. I think you're in Carolinas or Florida, but stay warm because Minnesota is going to get cold today.
I sure will. Thanks, Pat.
Take care.
If you're serious about building a more profitable business, make sure you subscribe to the Owner's Profit Playbook so you never miss an episode. And if you know another business owner who could benefit from this conversation, share it with them. To learn more about how we help business owners uncover hidden opportunities and strengthen their financial strategy, visit mancusocg.com. And remember, what you don't know is costing you commas and zeros.